Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured, US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. This is the Chit Chat Stocks podcast. My name is Brett Schaefer and joined as always by Ryan Henderson. But today we have a third guest on the show, recurring guest, someone who's been coming on the show almost as long as anyone. We really appreciate Alex supporting the podcast as we got it up and running back in the day. He's come on plenty of times in the past to discuss various companies. I think we've done ones on a lot of media stuff, as well as Airbnb. We had Spotify, actually Roku, which I thought was a fascinating one, even though it was a little bit different than some of the shows we've done in the past, where it wasn't as bullish or maybe like a bull thesis. But Alex runs the TSOH Investing Research Service on Substack, and a day before, or actually a day after we are recording this, but a day before this episode is being released, he has a new book out. And it is called Buffett and Munger Unscripted: 3 Decades of Investment and Business Insights from the Berkshire Hathaway Shareholder Meetings. So, Alex, that was a long lead-in. Welcome to the show. First question, why did you publish this book? What inspired you to write it?
Yeah, thanks for having me, guys. I remember one of the other ones that you didn't mention that I came on for was Netflix, and I remember it was the day that we were getting ready to record, and a well-known investor who I like a lot more. And I always liked him, but I like him a lot more now that he tweeted something about the book. A very well-known investor had sold Netflix that morning, and we were going to that pod like, oh boy, this is going to be the stock was obviously doing terribly too when we had that talk. So that was an interesting time. But yeah, always enjoy coming on. I started working on the book a couple years ago. I think when Berkshire announced in 2018 that they were releasing all the old annual meeting videos back to 1994, which up until that point had been, you couldn't access them basically. And I think I didn't start writing it at that point in time, but I think when that happened, it kind of clicked for me that there was an opportunity to do something very similar to the Larry Cunningham book, Essays of Warren Buffett, Lessons for Corporate America, which for me, when I started investing in, call it the mid to late 2000s, was really like a formative book for me in terms of learning about investing and learning about business. So I thought there was surely an opportunity to do something like that, but then I was going to have to also do the work. So it took some more time before that kernel kind of led to me to start rolling. I eventually got it moving a bit, and then at some point a couple of years ago, I reached out to Berkshire to get approval. They'd be okay with me doing this. And I kind of laid out the idea and told Warren that I was going to donate half of the proceeds to Glide, and hopefully that would be something that he was okay with. And thankfully they got back to me and said that I could move ahead. So at that point, the ball was really rolling. And it took a couple of years to get it done. And, really figuring out how to organize it at first was a little haphazard, but then eventually once I had a better understanding of how I was going to structure the book. It was, really just putting the time in. So yeah.
Yeah, and it seems like, well, not seems like, I've been perusing the book, and it's not something that, is a narrative going from, it's not a story. It's something that anyone who's interested, I think, in investing can pop through, say, oh, I'm interested in what Buffett and Munger talked about management, or what they talk about proxy statements in relation to that, incentives, all the stuff that they've talked about a lot in the annual meetings. And there's not 1,000, but maybe over 100 hours of recordings at this point from the annual meetings. Let me ask the second question here before we get kind of into the insights and some of the teases from the book. Who do you think should buy this book? Who would benefit the most from reading it?
Yeah, this answer is surely going to sound biased, but I really think anybody who's interested in business and investing is the perfect audience for this book. And again, I think it's very similar to the letters in the sense that when you're at an earlier stage in your career, you may read them and get certain insights that are fitting with where you're at in terms of your experience and knowledge. And as you become more experienced, I think there's other things that obviously will hit you differently, years down the road when you have a little bit more experience under your belt. I think, a lot of the things like thinking about cost of capital in terms of how the managers at the subsidiaries get paid and how they deal with the incentives of that relationship, thinking about stock options. There's a lot of things in here that for a brand new investor is going to be a little bit probably ahead of where they're at currently, and it's not going to be very valuable to them. But there's also a ton of other things in terms of the basic thinking around value investing and assessing managers and, things like that. Stock splits, what are they and why do they make sense or not make sense? There's a huge range of topics that will be definitely relevant for investing people, but even just business people, I think, as well.
Now, with Warren and Charlie, there's a lot of public speeches, essays, the annual meetings, all this to sift through. And for me, it would be probably an intimidating amount of information. So I guess, what was your process like for putting this together, and how did you compile everything?
I think there were some public sources that had reasonably decent starting transcripts for some of the years, which helped, but they weren't perfect. And one of the weird things too is as you listen to them talk and try to take spoken word, if it's just transcribed as they say it, there's a lot of times they talk where Warren will say the first couple words of a sentence and then trail off and go with a different thought. And so that would be, I had to go through all of it again. I couldn't just read it. I had to listen to it while editing that. So I started doing that at first. And then I got a couple years in and I was just purely going through and doing like the grammatical stuff. And after a couple years in, I was like, well, this is really stupid. I'm gonna have to go through all of this again to then organize it by subject. Maybe I should be doing this up front and having some structure for what this book is going to be. So I basically had to restart. Thankfully, it only been a couple years of the meetings. So yeah, then I went from there and started compiling in that fashion. So I had a big Excel document with basically every single question that was asked, and I had it time stamped, which people will see in the book. Every question says the meeting and then the spot that it aligns with on the YouTube videos that are available for the annual meetings. So I went through it in that fashion. Then I had to, as I started from the earliest meetings, let's say they're talking about something that they've talked about 20 times, the basics of value investing or something like that. I'd copy and paste into a larger document or a fresh document. Okay, this is value investing. Then as I go through, as I mentioned it at different meetings, I would basically try to find what I thought was the clearest explanation of what something is, or the one that made the most sense. So that was obviously an exercise as well that took some time. But as it really got rolling in the later years, then I'd already listened to 20 meetings or whatever it was. I had a really good sense for how to do this. So it got rolling a little bit faster towards the end, but the start was, there's a reason why it took me a couple of years to get this done.
Yeah, I mean, this seems like a project where in the middle of it, you're like, why did I do this? But now, I mean, the book's great. It's something that I'm going to definitely go back to from time to time, and especially if I'm focused on a certain topic and seeing what they've said. We're going to get to some, the lessons from the book, some stuff you learn from Buffett and Munger, what investors can apply. But maybe one funny question. You mentioned the repetitiveness sometimes of their stories. What do you think is the story that either Buffett or Munger repeated the most? Like, is there one that they just brought up every single meeting? Because I know there's some, they like to play the hits sometimes.
Yeah, I mean, it's hard for me to think of one right now. I know Warren always said at the one meeting, Charlie started talking about something. He goes, or he was getting ready to talk about something. He goes, and now Charlie's going to tell you for 10 minutes about the virtues of Costco or something like that. Like he always
exactly
always came back to that example of like, this is, and a lot of merit to that argument, to be fair, but it was a frequently used example. He told the funny story the one time, I'm sure people have heard this before, but of them being on a plane that got hijacked, and the hijackers said, you get one more wish, basically. And Charlie, he said, what's your wish? And Charlie said, I want to tell you the virtues of Costco, blah, blah, blah. And they said, okay, Warren, what's your wish? He's like, shoot me first or whatever. So I don't have to hear it again. So that was a common one. I mean, I think in the earlier years, there was a lot more of like, how do you invest, basically? How do you get the 50% annualized returns is a really common one that, the comments that he's made about being younger and being able to replicate those returns. But also the questions changed somewhat over time, especially as Berkshire obviously became more popular. And then they changed up the meeting structure where it wasn't just the audience questions all the time. They brought in, Becky Quick and Andrew Ross Sorkin and Doug Cass a couple of years, I believe. So that also changed the nature of kind of the questions that were getting asked at the meeting a little bit.
Going back through them, was there a period, was there a time frame of meetings that you enjoyed the most?
I think the late 90s meetings were really interesting, especially as it didn't get to like a fever pitch, but there were definitely times where the questions were more pointed in terms of like, what the hell are you guys doing? Just completely disregarding where the world's going type of mindset. And it was really interesting to watch them kind of navigate through that period. And even into the early 2000s as well, I think it was really interesting. And again, I think it gets to that time period where what the meetings were, I think, started to shift a little bit more. I mean, you really see it now, like when Warren, I can't remember if it was last year or the year before, basically did like a 30-minute or an hour introduction on, like capitalism and the American economy and stuff like this. The structure of some of these things is a lot different than how the meeting used to be. So I like some of the older meetings a bit more than some of the newer ones.
I do as well. I remember all three of us, the one meeting that Ryan and I have been to, we were at the famous one where in the morning session, I think there was a total of 3 questions answered. I think in the 90s meetings, there was more of a rapid fire pace. But let's get into some of the lessons from the book. There's a couple things, and look, there's much more covered in the book. Go buy it, I should say. We'll have a link. I forgot to mention this at the start. We'll have a link for the book in the show notes, the Amazon one, but you can find it at other places as well. The first lesson that I think we can talk about, and one that they discuss time and time again, are proper incentive structures. Maybe we can discuss first of what the problems they saw or still see in executive rooms and how that can, lead companies down a bad path.
Yeah, I mean, I think a lot of it is, at least at like the CEO level and dealing with shareholders. They talk about a lot of it in terms of obviously the amount of time that's spent communicating with investors. And it's something that kind of, after working on the book and obviously now having it come out and reading these things more, I mean, I think some people have said previously, it's kind of like going to church, like you already know all the stuff, but you kind of get it reinforced again. It really does make you step back and think about things that companies do, like, where they have an investor day and they say, okay, we're going to buy $3 billion of stock over the next 4 years. It's just like, it doesn't really make a ton of sense to do that. I get why you're doing it. And I understand why that becomes part of the incentive structure at a lot of public companies, but you just note how many things are kind of like that. And then you really have to wonder what's happening behind closed doors. And I think my favorite example, and it's discussed in the book, I actually put in the appendix, I put this article I wrote about National Indemnity. I think it's called The Right Way to Run an Insurance Company. and it's about the experience at National Indemnity from the early 1980s to 2004, I believe. And during that period, I'm going to get the years wrong now, but I think it was 82. In 1982, written premiums were like $60 million. 2 years later, they were $360 million. Then they went over a 15-year period where written premiums contracted by 85%. And then that's in 1999. So it's back down to 60 million or so now. 5 years later, written premiums were 600 million. So they went up 10x over the next 5 years. So significant volatility in the volume of production from that insurance business. And basically, when Warren walked through the example at I believe it was a 2004 meeting, which is in the book, talks about how, most businesses, the people who are working on the floor, in this case, the underwriters, obviously have an incentive to produce some set of volume. Otherwise, it's like, what is the point of your job? And you'll be fired. And National Indemnity made it very clear to their employees that nobody would ever be let go because of a lack of volume. They just wanted people to write profitable insurance and intelligent insurance versus just writing volume for the sake of writing volume. So when you look at the track record over the course of the 25-year period, it's very, very impressive. And by the way, the times when they were writing the most business were also the times when they had the best underwriting results. So averaged out, the profits, it basically works through that cycle in a way that actually made out well for National Indemnity. But it's just a really interesting example, as Warren lays it out, of thinking about how you have to worry about incentives throughout a whole organization, and how you really have to avoid things that send a message to employees that they should basically do something that's not, for the long-term benefit of the company. And I think that happens a lot with public companies. I've talked about at TSOH Investing Research. I've written a lot about Nike, and I think that's part of, it's not the only thing that's happened, but it's a company that had certain public financial targets that I think they tried to hit. And as they were dealing with other pressures, it led them to make incremental decisions that were not helpful to the situation. So it's what you have to watch out for in running a business.
Yeah, I mean, we talked about things that Munger, he's kind of the more repetitive one, or was. The one that he said all the time, I'll never forget, is show me the incentive, I'll show you the outcome. Seems like that applies time and time again throughout executive suites. And you can see from what they've discussed in this book and just in general that it doesn't take that many what seemingly feel like small changes to not destroy. I mean, Nike's still a big business, still a good business, but really change the trajectory of a company. One follow-up I have there, though, you'll hear Buffett talk about in these meetings, he'll mention, when you talk to management. And for most individuals, I think most listeners, they're not talking to management. But one thing he does talk about is reading a proxy statement and looking at that and saying, I don't need to talk to the management team. I can look at the proxy statement and say, yeah, this is someone that I agree with, or someone I would invest with, or someone that's not. Is there anything specific that like a listener can take away from here of, okay, I'm looking at a proxy statement, what's like a good incentive, what's a bad one? Or is it almost each time you're coming at it with a unique situation? Hopefully that question makes sense. Feels a bit convoluted, but
no, I don't think I have a blanket answer in terms of how I approach it in my own investing. I mean, I just look for things that are logical and somewhat straightforward, which again, it gets to a lot of what we're talking about here, right? Like, I mean, the example that people will see in the book in terms of how Berkshire compensates their managers at the subsidiaries. I mean, they explicit, I don't know the exact wording, obviously, but they say it's not rocket science. We know what we're incentivizing for. We know some businesses are better than others, and we account for that to some extent in how we set our compensation practices. We know businesses that have seasonal needs or working capital needs, and we can account for that too. And then from there, we really want to pay people based on, the key levers of value creation, which for them, I think more often than not, has been the cost that they attach to capital for managers who want to either reinvest in their business in some, non-standard or, some material way, or if they want to go out and do an acquisition or whatever, bolt on to their business. I think that's the main way that they think about it. The proxies that I read for a lot of public companies seem, one, kind of like overly complicated in terms of the number of variables that they're compensated on. two, a bit arbitrary when you can just pick some variable and go, okay, well, this one hit, so it pays at 200% of the bonus. And if the results for the company weren't even particularly good last year, you still get paid at least reasonably well. I think a lot of it is it's just close to nonsense. Basically, it's they're going to find a way to get the answer they want, and to the extent that it's more complex than less, it's for the sake of getting them giving them outs to the desired outcome versus it actually being rational and needed, in my opinion.
Yeah, tragically, that's all too common, and we've seen that dozens and dozens, maybe hundreds of times, looking at companies. And I haven't finished the book, but I've read a lot of the quotes from there, and especially with even analyzing businesses or analyzing management teams, it seems one big meta theme from all of their discussions is keep it simple. One of the quotes they use again is that Einstein one of keep things simpler or as simple as possible, but no simpler. And it seems like proxy statements, management incentives, and even running your business, it seems like something they would say is the best way to optimize results over the long term.
Yeah, absolutely.
Okay, let's talk some other lessons from your that you pulled from these meetings. The second lesson that you mentioned was just the continual learning as an investor. What were some of the things you drew revisiting all these meetings?
Yeah, I mean, I think the most fascinating example, and one that people probably know pretty well, is going back to the discussions around tech companies, even as early as call it the mid 1990s. Fast forward to, I have a quote from the 2012 meeting here in front of me. I pulled up. This is Warren. He says Google and Apple are extraordinary companies, obviously, and they're both huge companies. They make lots of money. They're in fantastic returns on capital. They look very tough to dislodge where they have their strengths. I would not be at all surprised to see them be worth a lot more money 10 years from now, but I wouldn't want to buy either one of them. And he goes on from there. That's 2012. And they made somewhat, they kept getting asked about probably the FANG stocks overall during this time period. And they made somewhat similar comments in 2013 or 2014. It's also in the book. And then fast forward a couple of years, and Berkshire has a position in Apple that at the peak was worth $180 billion or something like that. So again, I think it's really fascinating. He probably, I think Warren said at the time, right? He thinks about it a bit more in terms of a consumer product than the tech kind of component of what Apple is, which I think is a pretty fair statement. And what he said about the owning the phone screen and the value of that real estate at the time, I think he probably was ahead of other people in terms of really understanding what that meant for the company and for the business. So again, I think they've always shown a willingness to learn and be somewhat open-minded. While at the same time, I think they're rigid about kind of where they want to play or the things that they're willing to do kind of more generally. I think the example that sticks out to me as the most counter to that kind of point is, and this is inside of a business at Berkshire, but what happened with Geico and telematics is just an interesting period where they went through. I mean, it really was at least 5 years and close to a decade from when the conversation started at the meeting about telematics to when they basically said, "Hey, we've got this wrong. We should have been doing this," basically. And I don't know how much of that was a technology changing. Snapshot with Progressive at one point was a piece of hardware that you stuck into the car on your own, and who knows how expensive that was to do versus having a cell phone in your car today, something like that. So maybe those things changed in a significant way, but that was one example where it seemed like they were in a business, obviously they talk about all the time, that's very valuable to Berkshire. They were pretty slow to kind of catch up there, and they're still paying for it today.
Yeah, part of their philosophy from my read of it is they want to never make an error of commission. So like when they make a decision, they don't want it to be bad, but they're going to, given the rigidity that you talked about, they're going to make some errors of omission. The Google one being one, and also maybe that Geico example as well. For anyone watching the video, I was looking at the actual book here, trying to pull up a quote for our next lesson, which is, this is something I still have a hard time fully grasping what Munger's trying to say. Sometimes he was a, mysterious monk. But he talks about avoiding difficult decisions. For anyone that has the book, it's on page 26. And he Buffett kind of tees him up, and he talks about how not trying to be a hero and all these things, and kind of when you're inverted and you maybe try to do hard things, he calls it dangerous. Can you describe that? Because I think some investors have, or anyone reading this, listening to this, can maybe have a hard time understanding this. What do you think they're trying to get at with the avoiding difficult decisions mantra?
Yeah, I mean, I think it kind of gets to what I was trying to say a minute ago in terms of, and I tweeted it today, so it's top of mind for me as well. When Charlie talks about Warren's investment in PetroChina, I believe it was in 2003, and Warren basically says, anybody, I just found it by reading the annual reports. Anybody could have found it. It didn't require anything special. And Charlie says, well, when you were buying it, I don't remember anybody else doing it. He's like, that's not common sense. It's what an old Omaha friend would call uncommon sense. And at the second part of the quote, he says something along the lines of, I think we benefited from basically having huge swaths of things that just are completely out of bounds from what we do, and they don't take any of our time, and they don't distract us at all. And then we have the things that we may do, and obviously they prefer to do them in size when they do go after those things, and that helps them to some extent to not just to figure out where you're going to play, but when you then look at those things to make the decision on what to kind of go after. So I think about avoiding difficult decisions basically in that way of really quickly getting to the filter of, Charlie obviously talks a ton about opportunity costs throughout his life, getting to the point where you have the relatively short list of things that you're even confident enough to say you are willing to put to that opportunity cost test. A lot of things just simply don't even get that far. It's a great way to, I feel like it's similar to how, a lot of investors who, particularly those with a longer term mindset, I'm thinking like a firm like Ockrey comes to mind. I think they write about things, and they may have explicitly said this, so I'm not misremembering, that their investment universe is basically like 1% of the publicly traded companies that they've looked at. Like that type of filtering just gets you to a different starting point from, okay, now how do we make a decision from here?
Yeah, and it comes down to, or back to, I feel like I'm just name dropping Munger quotes, but the one quote that I had trouble understanding at first, but I kind of think I understand it now, is the avoiding tell me where I'm going to die so I never go there. I always thought that when you first hear that, you're like, wait, what is he talking about? But I think he's talking about the same thing, where it's avoiding decisions that you're trying to do hard things as a business, and it's going to set you up for failure.
Yeah.
All right. Now, having, I guess, published, done all the research for years on end, what, I guess, if anything, have you learned about Buffett and Munger that you didn't know prior to writing this book?
Yeah, I mean, it's very difficult to say at what point I learned what things about Buffett and Munger, because I've been, learning about them for close to 2 decades now, or right around 2 decades. I think the national indemnity example I said earlier is a really prominent one, and Warren wrote it up he wrote about it in the 2004-2005 shareholder letter, so it's not like he hasn't talked about it before. I think what's true in the book, in the meetings overall, which then obviously shines through in the book relative to something like the shareholder letters or Larry Cunningham's book, the way that they talk about things at the meeting is somewhat different than the way that they talk about things in the letters, because obviously it's, less of it's unscripted, to use the title of the book. So sometimes the things they say, or the direction that the conversation goes in, is slightly different. In this case, I'm thinking of the fact that at the end of the conversation, Warren basically notes it's the right way to run an insurance company, but the takeaway from everything they say isn't applicable everywhere. You couldn't run an auto OEM this way, or a bunch of other businesses this way, and you have to adjust your way of thinking for the different dynamics within any given business. Which, again, like, a lot of this stuff is really simplistic and obvious and straightforward, but things that you don't necessarily pick up on unless you're actually thinking about them deeply. So the national indemnity example and kind of what it teaches is definitely a big one.
This episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they collect and summarize the best stock pitches and bring them to you in a single place. If you are a regular listener to Chit Chat Stocks, you know that we use Yellow Brick every single week here on the podcast to discover new investments or maintain existing coverage on companies we already know. Try it for yourself. Simply go to joinyellowbrick.com/chitchat and search a company or ticker you are interested in. You are bound to find a great report on just about any company. That's joinyellowbrick.com/chitchat.
All right, I'm going to skip around to, before we talk about your investing style at TSOH Research, I'm going to skip to this other question, which is about their philosophy again, some stuff you covered in the book. And we talked about it a bit beforehand, how it's kind of hard to find things, just given how, popular they are and how wise they, were building up over the decades. But what do you think is something that a lot of investors, or something you see people misunderstand when studying Buffett and Munger's philosophy, and how people make mistakes trying to take what they say and applying it to their personal investing?
Yeah, as you just said, it's hard for me to find examples. And again, what I think and how much of that's influenced by them is also where this gets difficult. I don't totally know how people perceive them. I mean, I think a prominent one, which is maybe less true than it probably was at one point in time, is thinking of them as value investors in the sense of just paying low multiples. I mean, but they've explicitly said all along that that's not how they define value. It's obviously part of trying to ascertain what value is. I think it was most prominent to me, and after they hired Todd and Ted, the investment managers, and one of them bought Amazon, someone at one of the meetings was like, "What the heck are these guys doing? This is not value investing." And Warren got up there and said, there's no difference between buying Amazon or buying some bank at, a discount to book value or something. Both of them can be value investments. It just depends on all the factors that go in that decision. So that's probably one of the most notable ones. I guess another one that could answer here is what they did with silver and some other, arbitrage type plays back in the 90s in that time period. And then eventually I think they basically just stopped doing that stuff outside of, they did the Microsoft ATBI thing. But I think in a lot of ways, I was thinking about this before, I think Warren in a lot of ways he always talked about Ben Graham and how Ben Graham liked what he was doing. It worked for one, but also he liked the fact that it was really teachable. And I think there's part of Warren that likes the idea of, especially as he's gotten older, obviously, and Berkshire is at a very different place than where it used to be. And they're less effective, obviously, or less meaningful now, right? He can't do a lot of those things like the silver purchase that he did back in the day and have it have a large impact. But I think he likes the idea of teaching kind of the long-term investing, the, owning great businesses, partnering with good managers. He likes that style of teaching now too. So I think that's part of it all as well.
What are some of the things an individual, or maybe even yourself, can take away from this book and apply it to their own style? Is there anything that, after having written this book, I know it's hard because the learning evolution with Buffett and Munger is seemingly perpetual, like it just keeps going. But is there anything you took away that you may be trying to apply more to your own investing style?
Yeah, I think, again, it really depends on how you invest, obviously. But for someone like myself who runs, pretty concentrated and also tends to want to own positions for a long period of time, it's really that comment that I said earlier about finding managers at businesses. Obviously, you'd like to find high quality businesses, but also managers that are operating in a way that's intelligent. And a lot of these things the tests are not particularly difficult in terms of, a sensible capital allocation strategy, or even the way they talk about things like that, right? And the reality is a lot of companies kind of fail that test. And I don't think you can be so black or white in how you assess some of these things, or else the list of companies that do pass is going to get very short very quickly. But it should definitely be taken into consideration. And I think it's pretty darn meaningful in terms of talking about owning something for a long period of time, as these small things kind of compound.
What you mentioned diversification and concentration there. What do they say, Buffett and Munger say about diversification? Because I think you see, at least especially when I'm pulling a quote from a Motley Fool article or something like that, Buffett that plays well in the headlines. You can write that, get some good clicks. But it seems like there's conflicting quotes and people maybe misinterpret them. What do they say about diversification? And again, do you think other investors can learn from that?
Yeah, I think they basically say if you're someone who knows what they're doing, which is not necessarily the easiest thing to know, whether or not you know what you're doing. Sometimes it takes a little bit of investing for 5, 10, 20 years to figure out whether or not you know what you're doing, right? But if you know what you're doing, then you should, they don't say these exact words, but you should be willing to place decent sized bets when you find things that look attractive. So that would lead to a smaller number of positions. And they say on the opposite end, if you are what they call, I believe, a know-nothing investor, or someone who isn't going to be doing this stuff in a way where they really have reason to believe that they should have good results, then the answer should be to diversify. And I think they'd say an S&P 500 index fund, something like that. I think that's the general idea. Those are some of the quotes that get, I think, the most pushback when I've shared them, are the ones along the line of, where I think one of them, Warren says to Charlie, you've had a position that you had, I think he says more than 100% of your net worth in at one point, right? And Charlie responds, sure. Like very flippant, like, yeah, I've had that before. I know people get worked up, like that's Charlie Munger doing it. And if other people do it, that'd be idiotic, basically, or they're going to blow themselves up, which is a fair point. But also people need to be smart enough to recognize that he's Charlie Munger and, what he's doing. You need to be at that level to operate that way, which very, very, very few of us are. So.
Yeah. And it seems like first you have to internalize the lesson that Buffett's lesson number one, which is don't lose money. And I don't think it's different than I mentioned the Motley Fool, the high risk growth stock approach, where you have a lot of stuff out there and then you get a couple of Netflix and Amazons or Nvidias in a venture capital style approach. Where Buffett and Munger, they seem to be, they were looking for stuff that they were almost guaranteed not to lose money. I know a guarantee is hard to say in investing, but there was upside, but then just a minimal amount of downside. Did they talk about that at all? Or do they, like how different investment styles are, I guess, can apply to putting 100% of your portfolio into something? Because I guess I'd be afraid of, especially today with the AI boom and unprofitable companies doing so well, of someone saying, look, Buffett and Munger put 100% of their portfolio in American Express or whatever the company was. I'm going to do it with this quantum computing stock. Sorry for the quantum computing stocks, but what do you think about that? Is that like the misinterpreting? Is that something that you would, I don't know, do they talk about that, or am I reading it wrong?
No, I think they more so have left it to someone to reasonably and intelligently interpret like what they're saying, and to make, I mean, especially Charlie. I mean, he's repeated this multiple times over the years, which means I'm now going to butcher how I repeat it back. But I think he said the example of someone, going to Mozart and saying, how do you compose music? And he basically says, someone who was 20 or something, however old they were, 12, how do you compose music? And Mozart says, you're not old enough. And the person said, well, you were my age when you started doing it. He's like, yeah, but I wasn't running around asking somebody else how to do it. Like I was like, so I think there's something to that idea of, again, I personally like it now that I'm at a certain stage of development as an investor. The conversation isn't really dumbed down, especially on some of these topics like concentration and position sizing. It's discussed very honestly, and it requires a certain level of understanding of like the things you're talking about in terms of thinking what the application of that kind of looks like. And I think and again, you can see it in Berkshire's own actions, right? I mean, Apple was, when Berkshire was a huge company at this point in time, Apple was a very significant percentage of the equity portfolio and a reasonably significant percentage of the overall asset base of the company. So they've had, and Coca-Cola was a very similar situation in especially in the late 90s. It was up to, I think it was at 35 or north of 35% of the equity book. Like those were big swings at a time when Berkshire was starting to become a pretty sizable company. So, yeah.
Okay. I do want to shift gears a little bit and talk about your research service. But before I will plug the book just one more time. If you are like me or any of us that are interested in everything Buffett and Munger have had to say over the years, there's a ton. But if you want a more organized summary and someone who's done a lot of the work digging through it, this is a wonderful way to get that. So I highly recommend checking out the book. Just one more time on the name, Buffett and Munger Unscripted, in case you guys are looking for it. But I do want to talk about your research service. So I guess maybe for anyone who has not heard you on this show before, I know our recurring listeners probably have, maybe give us like the thumbnails of TSOH and some of the stocks you cover and kind of the philosophy of running it and how you show your portfolio as well.
Sure. Thanks for the plug for the book, by the way. I appreciate that. I guess a short background on I worked in the finance industry as a buy-side equity analyst for roughly a decade before starting TSOH Investment Research in 2021. I was also writing online throughout that period preceding the launch for about a decade as well. So that kind of brought the research skills that I acquired and the writing together to launch this service in 2021. And the premise of it is I post write-ups every Monday and every other Thursday. And it's a mix of kind of like initiation, call it deep dive type write-ups. Like recently I've written up Brown Foreman and looked at Academy Sports and Dick's Sporting Goods. And then there's also updates like Nike, as I was discussing earlier. It's a company that's updated on recently. There's some investment philosophy discussions. There's some broader commentary, kind of similar to the National Indemnity article that I referenced before. So it's kind of a mix of different write-ups. And then there's also complete portfolio transparency, and I disclose every change I make in the portfolio before I make it. The day before at 5 p.m. Eastern time, I'll send an email saying, hey, here's my portfolio as of right now, here's the changes I'm making, and here's the ending portfolio, and here's the reason why I'm doing it. And that was kind of born out of coming out of the finance industry and being not loving the fact that a lot of conversations were about like, oh, what stock are we buying now? We're buying Microsoft, we're buying Procter & Gamble, whatever it may be. But then there was never really much of the follow-on conversation of like, okay, well, it's a 30 basis point position in my portfolio, or it's a 3 percentage point position, or it's a 15 percentage point. Like the sizing of the position is incredibly important to that conversation. And then talking about the changes to get there is obviously incredibly important as well. So I wanted to be able to talk about those things, very transparently. And it's something I had learned from having written for the prior decade that, forcing that level of transparency also forces a certain level of kind of continued evolution and learning. Because at least I know for me, I certainly don't have the answers to all of the questions that kind of underlie how to invest intelligently, what I think is intelligent. So that's kind of the underlying, nature of TSOH Investment Research. And then the companies that I own / follow are, again, the names I just mentioned, bunch of media companies, Netflix, Disney, those kind of names, a few kind of oddball type things, Ally Financial, Fevertree, follow a decent number of retailers. So yeah, I have the list on the website of the last 6 months of write-ups that give people a decent idea of the other names.
All right, listeners, we've got a new sponsor here at Chit Chat Stocks, and their name is Blue Chippers Club. Blue Chippers Club was recently started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and participate in weekly calls. We truly love this idea, and it's why we're promoting it here on the show. In fact, we are in this community ourselves and enjoy just how much value we get by collaborating with other investors. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. The link is in the description. All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered, SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description. Yeah, I was just reading the Brown-Forman one this morning. We love the service. And if you're sick of the analyst questions or reports about gross margins expanding 10 basis points next quarter and constant discussions about that on conference calls and in reports, and if you're paying too much for stuff you don't find value in, this is the service for you. And it is, again, focused on the fundamentals, focused on the long-term story, stuff that we talk about, our listeners talk about often. I'm trying to think of one final question. Maybe tease like some companies you plan on covering or are like is on your list for future coverage at TSOH Investing Research, and maybe why those interest you.
I'm pulling up my running list that I have as I'm going to start saying some of the ones that come to mind. So having just looked at Brown-Forman and having some interest in Fever Tree as well. I'm going to probably look at Diageo here pretty soon. I looked at FanDuel somewhat recently. I'm not totally sure how I feel about the space, whether or not it's something I'm really interested in investing in or not. But if to the extent that is something that I might do, I'm going to look at DraftKings and probably at, I believe it's called Sport Radar. So those are a couple names there. There's a couple of names that I probably need to update on here pretty soon. Vita Coco is a somewhat interesting one to me. Portillo's, which I know you guys follow. Peloton, Grocery Outlet. So those are some of the ones that I'm kind of continuing to keep an eye on that I've looked at previously.
I was reading some of your Brown-Forman write-up this morning as well. You mentioned you're doing Diageo here. I guess any takeaways in looking at some of these spirits producers that you could share? I saw the other day that like pretty much all three of the big ones that I could think of here, Pernod Ricard, Brown-Forman, Diageo, are all trading at record low or decade low multiples. What have been kind of your early takeaways from looking at these businesses?
Yeah, I think it's one where the COVID pandemic headwind, tailwind, and how it's all shaking out isn't quite clear to me yet, which is I didn't think at the time I'd be saying this in early 2025, but that's true in more industries than I thought it would be in terms of how the reported financials shake out. In terms of how the companies are managed, I was surprised at the strength of Jack Daniels, both domestically and abroad. But then also as I dug in more, I saw how the company's kind of capital allocation and portfolio management strategy had worked its way through over the past, call it 25 years or so. And just interesting to think about how you have a really dominant brand that can play globally. What's the most intelligent kind of capital allocation and strategy to run from there? I think it partly depends on who the stakeholders are and how much of their wealth is invested in it and how much of their life is invested in it too, their name, their family, etc. So I think that's interesting to think about. I'm not totally sure I've seen some data that basically suggests that alcohol consumption is pretty similar to where it has been. I've seen some other data that suggests younger people are not drinking as much as their previous generations. So I need to do a bit more digging there to have confident thoughts. But what have you guys thought about that, or have you looked into it much?
God, I want to like these companies, but I looked at Diageo and we talked about the management stuff and the incentives things, and I just felt like there was a lot of focus on compensation consultant stuff and things that just didn't really please me in that regard. I was shocked that I pulled up like on FinChat. I guess I should shout out our sponsor. Go use our link, finchat.io/chitchat. Get 15% off any paid plan. But I pulled up their revenue chart. I was shocked at how slow their revenue growth has been. Maybe I was overestimating it, but for a company that I believe was trading at a very premium earnings multiple, I don't know. Were you shocked at that? I guess I just thought the growth would be better.
I just think the one thing and I don't know about Diageo specifically, but my sense is that all of them have had a decent amount of M&A and divestitures too. So you just have to getting clean numbers from there is always a little bit difficult. I mean, even the thing where here's an organic sales growth for this year, but the go forward then includes that acquired business in the organic numbers.
Yeah.
So even just trying to get clarity on something like that it just gets a little bit messier when companies have a lot of portfolio movement. And again, I don't know about Diageo, but Brown-Forman has had enough of that over the past, again, like 25 years, well, even more than that, but that's the period I looked at most closely, that it made it, that part a little bit challenging. They do have some good volume data though, that kind of gave the indication, at least for the core Jack Daniel's family, that brand has had, not crazy growth, but pretty consistent and solid growth, call it something like 5% annualized volumes, over the past 20, 30 years, which again, that's pretty good for a brand that's very well established, and the cash flow dynamics in the business are pretty attractive too. So it's a situation I think that could work pretty well if you have confidence that something like that will continue going forward. But yeah, I need to do a little more digging personally.
Diageo is similar with the spinning out stuff, buying a lot of things. I don't know, Ryan, what are your thoughts?
Yeah, I've seen some of the data. I've seen very mixed data on alcohol consumption overall. I've seen charts that show alcohol consumption in the States is just fine. It's kind of where it's been historically. And then I saw one chart that said like Gen Z spends way less on alcohol, and it's like half of Gen Z is below the drinking age. So it didn't, and the chart kind of went viral. And so it didn't really make a whole lot of sense. But the other part is you even see some commentary from the management teams about like shifting towards premium alcohols, not as much spend on kind of the lower tier. I kind of had some worries when they acquired, what was his, I always forget the celebrity's name, his tequila. George Clooney, had a tequila brand, Casamigos. And it worried me that playbook for like big celebrity presences, like I know The Rock has made his own, Matthew McConaughey has made his own bourbon, and all this stuff can kind of eat away at the edges of like Diageo's core brands and some of the other companies as well. But other than Casamigos, I'm yet to see any real proof of that. So I don't know. It's kind of a mixed bag, but I would love to like them because it seems like they have some big advantages, but there's something just kind of holding me out, and I don't really know what it is.
Yeah, I think that's it's a lot of what I was thinking too on Jack Daniel's, and thinking about they're going through a similar path of, some incremental brands, but also some kind of line extensions within the Jack Daniel's family that move it further up the, premium, super premium scale. And they also have flavors and some other things that have generated a significant amount of volume for the brand. And I think you've seen things like this before. I think in probably vodka is the most notable, where there was like every flavor under the sun at one point, I think. And I think from what I've heard, I think my understanding is that Tito's has probably been the most successful vodka brand in the last handful of years or whatever. And they're probably, I'm sure others have done this too, some of them, but Tito's has kind of stayed true to their core identity, right? They weren't selling cotton candy flavored vodka as far as I know anywhere. So maybe there's something to be said. Also, you have to be very careful in terms of how much of that you do, particularly if you're trying to, move up scale in terms of premium or super premium.
Yeah, one final mention. You talked about Fever Tree. I posted that chart about Brown-Forman and how the revenue growth wasn't as exciting as I thought it would be. Someone sent me a DM, I guess someone that we all know, and they said the best way to play this is Fever Tree. I guess maybe that could be the case. We don't have time to go full in depth on Fever Tree, but what are they, and what do you cover about them? What interests you about them at TSOH?
Yeah, Fever Tree is basically I guess you would say, like a premium tonics company. I've kind of had some of the math on this in my first Fever Tree write-up. If you comp it to like a liter of Schweppes or whatever would be on the shelf at the grocery store of that tonic water, it's something like somewhere between 5 and 10 times more expensive on a per ounce basis. Also, the product is significantly better. And if you're mixing tonic with a spirit that costs, $50 for a 750 milliliter bottle or whatever it may be, then maybe you don't want to go cheap on the mixer. So I think they've certainly established their position, in their home market in the UK. They've also done a very good job. It's still early, but they've done a very good job at establishing their position in the US. Now, that said, the pandemic was, a pretty difficult situation for them, particularly in terms of product production and, product sourcing basically too. So they've gone through a period where the margin profile has been really, it's significantly lower than what it used to be on both gross and operating margins. And, part of the question now is how do they kind of get back to where they once were or anywhere close to where they once were? And then also what's kind of the top line growth trajectory going forward as a market like the UK, it's a sizable market for them and a good market for them, but it seems like it's kind of tapped out to some extent, particularly in terms of the G&T kind of play. So, it's one where you have to have some thoughts on how big that market actually is, how strong is their competitive position. And then you need to answer whether or not there's anything to really be paid for in terms of, adult soft drinks or, the non-carbonated mixers. So I think it's a really interesting company. I wrote about it here fairly recently, so people can read about it if they're interested.
Yeah, fascinating company. Ryan, any other questions before we close out here?
No, I'll just give a pitch to the audience. I love reading TSOH Investment Research, and there are a ton of companies that we didn't even mention today that are in Alex's coverage universe. Some of the ones that are coming to mind for me, since I just took a road trip across the country, are some of the discount retailers, dollar stores, which you'll see throughout a lot of the
We saw a lot of Dollar
populated
Generals
towns
in Middle
Yes.
America, Ryan. Yeah,
Certainly did. And every time I thought, you know what, what do they say? We go where they ain't.
We went where they ain't.
Yeah, I understand that now very much.
There you go.
But yeah, there's tons of great companies in the coverage universe. So I recommend at least checking it out and seeing if there's any companies, write-ups, types of things that you like if you're listening now.
All right, Alex, thank you for joining us. Anything else before we close out and hit the disclosure?
That's it. Thank you for having me. And yeah, people check out the book if you're interested. I think you'll love it. If you're listening to this show, you're going to be someone who likes this book.
Yep, I was going to say the exact same thing. Yeah, exactly. Yep. Thank you, Alex, for joining. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again for listening to this episode. Go download, buy the book, and check out the TSOH Investing Research Service. And we'll see you next time.